3 weeks ago, something happened that almost nobody noticed. While headlines were busy talking about tech stocks, elections, and interest rates, a quiet shift began inside the global financial system. Trading behavior changed in China. Emergency alerts started circulating among hedge funds, and analysts who normally argue about small price targets suddenly began whispering a number that sounds unbelievable: $6,000 per ounce of gold. That number isn't coming from social media influencers or retail traders. It's coming from institutional models, risk desks, and people whose job is to prepare for events before the public even realizes they exist. If this sounds dramatic, stay with me, because by the end of this video, you'll understand why markets may be entering a phase that only happens once every few decades, and why the signals are hiding in plain sight. Before we go deeper, if you want clear explanations about global finance without mainstream noise, take 1 second to like this video and subscribe to The Silent Collapse. It helps the channel reach more people who want facts instead of hype. It tells the algorithm you want more deep analysis like this. Now, here's where things get interesting. Central banks around the world have been buying gold at record levels, not slightly higher, not normal accumulation. Record levels? According to publicly available reserve data, governments purchased more gold recently than at any point in modern financial history. And central banks don't chase trends. They prepare for risk. They move slowly, quietly, and years ahead of everyone else. When institutions that control national currencies start accumulating hard assets simultaneously, it usually signals a lack of confidence in the stability of the current monetary environment. At the same time, unusual activity began appearing inside Chinese commodity markets. Reports of trading interruptions and liquidity tightening triggered speculation among analysts. Official explanations described technical adjustments and regulatory controls, but large funds noticed something else: volatility suppression followed by sudden price rebalancing. In simple terms, markets didn't behave naturally. And when markets stop behaving naturally, professionals start asking whether price discovery is being managed rather than allowed to move freely. Meanwhile, geopolitical tension added another layer. Statements coming from Iran's supreme leader were interpreted by energy analysts as signals of long-term regional positioning rather than short-term political messaging. Oil traders began adjusting risk exposure. Currency desks increased hedging activity. And gold, historically the asset investors run to during uncertainty, started receiving renewed attention from institutional buyers. Here's the key idea most people miss. Gold doesn't rise simply because people like gold. Gold rises when trust falls. Trust in currencies, trust in stability, trust in debt systems. And right now, multiple pressures are hitting the global economy at the same time. Inflation hasn't fully disappeared, government debt continues expanding, and geopolitical alliances are shifting into competing economic blocs. Around 4 minutes into analyzing this trend, you start seeing what analysts call fragmentation. For decades, the global economy operated under one dominant financial structure. Trade flowed smoothly, currencies were interconnected, and the US dollar acted as the center of global settlement. But now new alliances are forming that want alternatives, systems that cannot be frozen, sanctioned, or digitally restricted. Gold fits that role perfectly because it exists outside political control once physically owned. Think about this logically. Digital assets can be tracked. Bank reserves can be frozen. Currency transfers can be blocked. But physical gold remains neutral. It doesn't require permission. And in a world where economic power increasingly overlaps with political conflict, neutrality becomes extremely valuable. Now, let's talk about the number everyone is debating: $6,000 gold. Is it realistic? On the surface, it sounds extreme. But analysts aren't pulling that figure out of thin air. They are modeling scenarios based on debt expansion relative to gold reserves. Global sovereign debt has grown dramatically over the last decade. When debt increases faster than economic productivity, currencies gradually lose purchasing power. Gold, historically, adjusts upward to reflect that imbalance. Another factor rarely discussed publicly is market positioning by large institutions. Insider reports don't mean illegal leaks. They refer to observable behavior. Hedge funds increasing commodities exposure, sovereign wealth funds diversifying reserves, long-duration bond demand weakening while tangible assets gain attention. Individually, these signals look small. Together, they form a pattern. And patterns matter more than headlines. Some analysts believe markets are currently experiencing controlled volatility. In other words, prices move within ranges that prevent panic while underlying pressures build quietly. This is where accusations of market manipulation often appear. Whether intentional or structural, large financial systems naturally attempt stability because sudden instability threatens everything connected to them. That means price suppression or delayed reactions can occur simply because institutions intervene to maintain confidence. But history shows something important. Financial systems change slowly and then all at once. The 1970s gold surge didn't happen overnight. Neither did the housing bubble or the tech boom. Signals appeared years earlier, ignored by most people, until momentum became unstoppable. Right now, we may be watching early signals again. China reducing dependency on external financial systems, Middle Eastern geopolitical positioning influencing energy markets, central banks diversifying reserves, and retail investors slowly rediscovering hard assets after years focused only on stocks and crypto. Here's another question worth asking. Why would governments accumulate gold if digital finance is supposedly the future? Because diversification protects against uncertainty. Governments plan for worst-case scenarios even when publicly projecting confidence. Preparation doesn't mean collapse is guaranteed, but it does mean risk is being taken seriously at the highest levels. For everyday investors in the United States, the real story isn't fear, it's awareness. Market transitions create both danger and opportunity. When currencies weaken, assets tied to real value tend to outperform. That's why analysts track gold alongside oil, commodities, and inflation expectations. Now imagine a scenario where multiple catalysts align. Continued debt expansion, persistent inflation pressures, currency competition between economic blocs, increased geopolitical risk. None of these alone push gold to extreme levels, but combined, they can reshape pricing models entirely. And this brings us back to China's trading behavior. If liquidity controls or trading pauses become more common, it signals governments prioritizing stability over free market movement. That alone changes investor psychology. Markets rely on confidence. Once participants suspect intervention, they seek assets outside the system, again strengthening gold's appeal. Some critics argue predictions like $6,000 gold are exaggerated, and they might be right in the short term. Markets rarely move in straight lines. Corrections happen. Manipulation claims appear. Prices fluctuate. But long-term trends depend on macro forces, not daily headlines. What matters is direction, not speed. The silent collapse focuses on these slow structural changes because they often go unnoticed until outcomes become obvious. By the time mainstream media declares a new financial era, institutional positioning has already been completed. So what should viewers actually watch moving forward? First, central bank purchase reports. Second, currency volatility between major economies. Third, energy market reactions to geopolitical statements. And fourth, changes in bond market demand, because bonds often signal stress before equities do. If gold approaches new highs, expect debate to intensify. Some will call it panic buying. Others will call it manipulation. But underneath those arguments lies a simpler truth. Markets reflect confidence levels. Rising gold often signals declining trust somewhere else. And here's the deeper psychological shift happening right now. Investors are moving from growth obsession to preservation thinking. After years of chasing returns, many are asking how to protect purchasing power instead. That mindset change alone can drive massive capital flows over time. As we approach the end of this analysis, remember that financial transformations rarely announce themselves clearly. They appear as small, disconnected events, a trading halt here, a policy shift there, a sudden surge in central bank buying, until one day the pattern becomes undeniable. So the real question isn't whether gold hits $6,000 tomorrow. The real question is whether the global system is entering a phase where traditional assumptions no longer hold. If fragmentation continues and trust continues shifting, price targets once considered impossible may slowly become realistic. I want to hear your opinion because discussion helps everyone understand these trends better. Do you believe gold reaches $3,000 first, or do you think markets will push prices back down through intervention? Write your prediction in the comments and explain why. Your perspective might help someone else see the bigger picture. If this breakdown helped you understand what's happening behind the headlines, share this video with someone who follows markets but wants deeper context. And make sure you stay with the silent collapse, because the next phase of this story is already developing, and the signals we watch today may define the financial reality of tomorrow.